Hello everyone, this is Johnny again, and I'm recording this video to show you how the simplified H4 liquidity and FVG strategy is done. Okay, so let's take an example. This example will be done on the AUD USD Forex pair. Know that this strategy can also be used, preferably on stock indices. Forex majors like euro dollar, pound dollar, uh, Australian dollar, US, New Zealand dollar, and USD JPY. Okay, so let's get right into it. So in order to do this strategy, you want to set up your time frame to 4 hours. You can also make use of a 20 SMA or smooth moving average, basically used as a trend filter. Okay, so what are we looking for here? So what we're looking for here would be liquidity grabs before we take a reversal trade to the opposite direction. So liquidity can be found in areas such as the swing highs or swing lows. So these are areas where liquidity may be these areas. So what we want to do is we want to wait for price to take out these liquidities, such as this. Here's another liquidity area, and it's been taken out by price right here. Taken out meaning it's been traded into, where price grabs on liquidity, and after liquidity has been taken, this actually resulted in price making a rally higher. In the same way, this liquidity was taken and price consolidated a little bit, but then rallied a lot higher. Okay, so let's take this example. Once the liquidity in this zone has been taken, we want to wait for a formation of a 4-hour fair value gap, which is right here. So once this fair value gap has formed, mind you that we prefer for our fair value gaps, single fair value gaps in a leg. Okay, so if there are two fair value gaps in a leg, that makes it less reliable, meaning lower probability. So in this case, after the liquidity grab, a 4-hour bullish fair value gap has formed. Okay, and it so happens that this is also above the 20 SMA, which means that the bias has shift from bearish to bullish. So what we want to do next after we have identified the 4-hour fair value gap is to place a pending buy order at the F fair value gap zone, and you put your stop loss at the nearest swing low. Now, this of course would be quite aggressive. This would be wide, but I would prefer this over this one. Then the target would be the nearest swing high, which what we're going to do is we're going to divide the position into two, whereby after the first take profit is hit, we will be taking partial profits. It can be 60% of the position or 70% of the position, and then letting the remainder of the position run higher. Okay, it could run higher towards this next high, or it could run higher towards the next high. We'll never know. Okay, so it's important that after we have um, taken partial profits at the nearest swing high, we let the position or the remainder of the position run so that we can still capture more profits. Now, it's important after the first take profit has been triggered, you want to move your stop loss to break even, making this a risk-free trade. Okay, then letting the rest of the position to run. and increasing your risk to reward ratio. And I hope this one helps. Thank you for listening.